Welcome back to Mastering MBA. In this video, we explore one of the most closely watched financial statements, the income statement, also known as the statement of earnings. If the balance sheet is a snapshot of where a company stands, the income statement is the story of what happened, how the company performed during the period. It tells us how much money came in, how much went out, and how much was left at the bottom line. Let's dive in and see how this statement captures a company's profitability, performance, and potential. Purpose of the income statement. The income statement reports revenues, expenses, net income, and earnings per share for a specific accounting period, often a year or quarter. It's based on the accrual method of accounting, meaning revenues and expenses are recorded when they're earned or incurred, not when cash actually changes hands. That's what makes the income statement different from the cash flow statement. The ultimate goal is simple: show how well the company's operations turn sales into profit. Income statement formats. There are two common formats for presenting this data. The single step format groups all revenues together and subtracts all expenses at once to reach net income, simple but not very informative. The multiple step format is more analytical. It provides several key performance measures like gross profit, operating income, and earnings before taxes. Analysts and investors prefer this because it shows how profit is built step by step. Comprehensive income. Now let's go one layer deeper into comprehensive income. Comprehensive income includes all changes in equity from non-owner sources. That means it's not just net income but also other comprehensive income or OCI. Examples of OCI items include foreign currency translation adjustments, unrealized gains or losses on available for sale securities, pension adjustments, cash flow hedge gains or losses. Companies must report comprehensive income right after the income statement or as a combined statement of comprehensive income. This provides a fuller picture of what's impacting shareholder value, even if it hasn't hit the income statement yet. Common size income statement. To analyze profitability effectively, analysts often use a common size income statement. Here, every line item is expressed as a percentage of net sales, making it easy to compare performance across years or competitors. For example, if cost of goods sold is 60% of sales and gross profit is 40%, you instantly see the firm's efficiency and cost structure. This technique helps isolate trends and identify whether profitability is improving or slipping. Section 2: Analyzing operating profitability. First is net sales revenue. Revenue or net sales is the total amount earned from customers, net of returns and allowances. To prevent abuse, the FASB's ASC 606 standard sets out a 5-step process for revenue recognition. First is identify the contract with the customer. Second is identify performance obligations. Third is determine the transaction price. Fourth is allocate the price to the obligations. Fifth is recognize revenue when performance obligations are satisfied. Analysts also distinguish between nominal sales growth, raw numbers, and real growth adjusted for inflation. And when sales increase, it's important to ask, is it because of higher prices, more volume, or both? Cost of goods. COGS. Next comes cost of goods sold, the direct cost of producing or purchasing goods that was sold during the period. COGS depends heavily on the company's inventory method. FIFO, first in, first out, uses older costs first. Ending inventory reflects current cost levels. LIFO, last in, first out, uses newer costs first. Results in higher COGS and lower profit during inflation but tax benefits. Average cost smooths out price fluctuations. A key metric here is the CGS percentage, calculated as COGS divided by net sales. This helps determine whether the company is managing production and purchasing efficiently. Gross profit or gross margin. Subtract COGS from net sales and you get gross profit, the first key profit measure. The gross profit margin shows how efficiently a company turns sales into profit after covering the direct costs of producing goods or services. It's calculated using a simple formula: gross profit margin equals gross profit divided by net sales. In other words, it tells us what percentage of each sales dollar the company keeps after paying for materials, labor, and production costs. A higher margin means stronger pricing power and cost control, while a declining margin can signal rising costs or competitive pressure. This ratio shows how effectively a company turns sales into profit after covering direct production costs. A declining gross margin can signal rising input costs or competitive pressure, while a stable or improving margin reflects strong cost control and pricing power. Operating expenses. Operating expenses represent the costs of running the business day to day. They include selling and administrative expenses, salaries, utilities, and office costs, advertising and marketing, discretionary spending that fuels future sales, depreciation and amortization, systematic allocation of long-term asset costs, repairs and maintenance necessary to keep assets productive, impairment charges when an asset's value falls below its book value. Cutting these expenses can boost short-term profit, but if management underinvests in marketing, R&D, or maintenance, it may hurt long growth. Operating profit, EBIT. When we subtract all operating expenses from gross profit, we reach operating profit, also called earnings before interest and taxes, EBIT. This is a core measure of operational efficiency, how well the company's core business performs, separate from financing or taxes. The operating profit margin measures how efficiently a company's core business turns sales into profit before considering interest and taxes. It's calculated using the formula operating profit margin equals operating profit divided by net sales. This ratio reveals how much of every sales dollar remains after covering all operating costs like salaries, rent, marketing, and depreciation. A higher operating margin means the company runs efficiently and controls its costs well. A lower margin may indicate rising expenses or pricing pressure. It's one of the best indicators of how strong or weak a company's core operations really are. It shows the company's ability to turn sales into profit before external factors like interest and taxes are considered. Section 3, Non-operating items and the bottom line. Other income and expenses. Companies also record gains or losses from non-operating activities, things not central to their main business. These include interest income or expense, gains or losses from selling investments or equipment, earnings or losses from affiliated companies. Analysts separate these from operating results to avoid confusing one-time events with sustainable profit. Taxes and earnings before tax. After including non-operating items, we reach earnings before income taxes, EBT. When analyzing profitability, analysts often look at a company's effective tax rate, the real percentage of income paid in taxes. It's calculated with this simple formula. Effective tax rate equals income tax expense divided by earnings before tax. This ratio shows how much of a company's pre-tax earnings are lost to taxes. If the rate is lower than expected, it could be due to tax credits, deductions, or foreign operations. If it's unusually high, it might signal fewer deductions or one-time tax adjustments. Understanding the effective tax rate helps reveal how tax strategy impacts the bottom line. It shows how much of a company's earnings are lost to taxes, and whether tax planning, credits, or foreign rates affect reported profits. Discontinued operations. Sometimes a company sells off a division or business line. When this happens, those results are shown separately on the income statement, net of tax, under discontinued operations. This helps analysts focus on continuing operations to predict future performance more accurately. Net earnings, the bottom line. After all revenues and expenses are considered, we arrive at the bottom line, net income. This is the company's final profit for the period and one of the most closely watched metrics in finance. The net profit margin is the ultimate measure of profitability. It shows how much of each sales dollar a company actually keeps as profit. It's calculated using the formula net profit margin equals net income divided by net sales. This ratio reflects everything revenue, expenses, taxes, and interest. A higher net profit margin means the company is efficient, managing both costs and pricing well. A lower margin might signal rising expenses, intense competition, or weak cost control. In short, the net profit margin reveals the company's true bottom line strength. It reveals how much profit the company retains from each dollar of revenue after every cost. Earnings per share (EPS). Finally, earnings are translated into a per share measure, earnings per common share (EPS). There are two types when it comes to measuring profit per share: analysts focus on earnings per share or EPS. There are two types you need to know. First is basic EPS. It's calculated as net earnings available to common shareholders divided by the weighted average number of shares outstanding. It tells you how much profit each existing share earned during the period. Second is diluted EPS. This one goes a step further. It assumes that all potential shares, like stock options or convertible bonds, were converted into common stock. That means diluted EPS usually comes out lower because it spreads earnings across more potential shares. In short, basic EPS shows today's profitability per share, while diluted EPS reveals what it could look like if every potential share became real. EPS helps investors assess profitability on a per share basis and compare performance between companies with different capital structures. Section 4, Statement of Stockholders' Equity. The statement of stockholders' equity explains how equity changes from one period to the next. It's the bridge between the balance sheet and income statement. This statement shows increases from net income and stock issuances, decreases from dividends or treasury stock repurchases, adjustments for comprehensive income items or accounting changes. It reveals how management's decisions, reinvesting profits or paying dividends, affect shareholder value over time. Section 5, Earnings Quality, Beyond the Numbers. Finally, not all earnings are created equal. Appendix 3A Guide to Earnings Quality reminds us to look beyond reported profit and ask whether earnings are sustainable. Here's what analysts watch for: aggressive revenue recognition or channel stuffing, cookie jar reserves, setting aside too much in good years to smooth future profits, understated depreciation or reduced R&D spending to inflate short-term income, one-time gains from asset sales being presented as recurring income, non-GAAP metrics like adjusted earnings that may exclude real costs. The goal is to adjust reported net income to reflect economic reality, the company's true ongoing performance. Key takeaway: the income statement isn't just about how much money was made, it's about how it was made. It shows efficiency, pricing power, and sustainability. But true insight comes from connecting the income statement with the balance sheet and cash flow statement, analyzing the quality behind the numbers. A company can report high profits, but if it's built on weak fundamentals or accounting tricks, the story behind the numbers tells the truth. Thanks for watching Chapter 3, The Income Statement, Measuring Profitability. In the next chapter, we'll look at cash flow, where real liquidity and business survival are measured. Content adapted from Fraser and Ormiston, 2023. Understanding Financial Statements, 12th edition, Pearson Education.